into the extreme, high-stakes world of clinical-stage biotech. We're looking at Jupiter Neurosciences, ticker symbol GNUS.
So what exactly are we dealing with here? Jupiter Neurosciences is a clinical-stage, capital-dependent microcap biotech. If you're coming into this looking for your standard valuation metrics, PE ratios, EV to EBITDA, just throw those right out the window. Seriously, they're completely useless here. Jupiter's entire existence and any potential value it has relies strictly on clinical trial success, getting FDA nods, and, frankly, their ability to just keep raising cash. This isn't a mature, earnings-based business. It's a highly speculative research entity, and it literally lives or dies on data readouts.
Now, a massive recent development is that Jupiter just totally transformed its identity. They went from a single-platform company to a dual-asset central nervous system biotech. On one hand, you have JOTROL. This is their proprietary micellar formulation of resveratrol, and it's currently in phase 2A trials for Parkinson's disease. The thing about resveratrol is, historically, it has incredibly poor oral absorption. Your body basically flushes it out before it can even do anything useful. So Jupiter's trying to solve that delivery puzzle. But then, out of nowhere, they just acquired the exclusive U.S. rights to ALA-002. This is a next-gen, non-racemic MDMA investigational drug stepping right into the booming psychedelic medicine space. It's a wild pivot, and honestly, it completely rewires their risk-reward profile.
Let's look at the timeline here. In November 2025, they hit a major milestone. The FDA cleared their investigational new drug application for JOTROL. Fast forward a bit to May 2026, and they officially started enrolling patients for their phase 2A reset trial. Then, just 2 months later in July 2026, they went ahead and scooped up those U.S. rights for ALA-002. But here's the absolutely crucial takeaway. That ongoing phase 2A trial for JOTROL, that is the ultimate immediate test. Because it's one thing to prove a chemical works in a petri dish, or to show your tech boosts absorption in the bloodstream. It's an entirely different beast to prove it actually changes human biology. Like, does it actually stop tremors in someone suffering from Parkinson's? That is the massive existential hurdle they have to clear.
Now, about that ALA-002 deal, when Jupiter announced this, the financial headlines were practically screaming about a massive $100 million acquisition. But hold on, because that number is incredibly misleading if you think it represents immediate debt. It's not. That $100 million is almost entirely tied to future developmental, regulatory, and commercial milestones. It's a classic biotech move, creatively structured to basically de-risk the deal for the buyer. You simply don't pay out the big bucks unless the drug actually works. In reality, the upfront cash Jupiter parted with was just $1.5 million plus about $1.8 million in stock. So the immediate financial hit is tiny. That's the good news. The bad news? Jupiter still has to somehow come up with the cash to fund all the insanely expensive clinical development required to ever actually hit those milestones. So why take on all this brutal clinical risk? Well, it's because the target markets, the total addressable markets, are absolutely staggering. If we look at the bullish dream here, we are talking about a $1 to $5 billion potential commercial market for Parkinson's disease alone, assuming JOTROL actually proves to be disease-modifying. If you broaden that scope to general neurodegeneration, like Alzheimer's, the market explodes to over $10 billion. Throw in the new psychedelic medicine angle for trauma and anxiety with ALA-002, and you've just added another multi-billion-dollar frontier. The market sizes are, without a doubt, undeniable. But let's be real for a second. A total addressable market is not the same thing as capturable revenue. For a microcap company, capturing even a single % of a $10 billion market is a monumental, almost impossible execution task. Before we go deeper into the numbers, I should mention Jupiter also has this consumer longevity brand called Nujevia. They sell skin creams and cognitive supplements. I'm going to very swiftly dismiss this as a core driver. Nujevia pulled in under $43,000 in revenue for the first half of 2026. Compare that tiny microscopic sliver to their $4.74 million in operating expenses. It's just economically insignificant. Now, maybe Nujevia becomes a fun side project down the line, but financially speaking, it is completely immaterial to our core investment thesis in this explainer today. Let's just sit with that financial reality for a second. $42,897. I'm hitting you with this microscopic number because it represents Jupiter's entire recorded revenue for the first 6 months of 2026. You literally cannot calculate a meaningful revenue growth rate from a baseline of basically zero. When you're evaluating a stock like this, you have to constantly remind yourself, I am not looking at a mature cash-flowing business. I am evaluating a cash-burning research lab, and it lives and dies purely by the grace of the capital markets. And to really drive that contrast home, let's look at their net loss for that exact same 6-month stretch. $4.34 million. Their operating cash burn was hovering right around $3.73 million. But here's what's even more alarming when you look under the hood. Their general and administrative expenses actually shot up roughly 45% year over year during that period. So corporate overhead is expanding rapidly while commercial revenue is sitting practically at zero. This is a massive red flag. It highlights extreme cash burn inefficiency, and it tells us they're scaling up their corporate infrastructure way faster than they're scaling their actual business.
Which inevitably brings us to the balance sheet. And guys, it is not pretty. As of June 30, 2026, Jupiter Neurosciences had a negative $366,000 in shareholder equity. What does that literally mean in plain English? It means their liabilities completely exceed their assets. If they were to liquidate everything tomorrow, they would still owe money. This is exactly why standard financial ratios like return on equity or return on invested capital are totally distorted here. The underlying equity is quite literally underwater. It proves beyond a shadow of a doubt that this company is living dangerously close to the edge.
And that grim reality culminates in this exact quote. This is directly from the company's own management and their auditors. I'll read it word for word. Substantial doubt regarding the company's ability to continue as a going concern. Look, that is not just some boilerplate legal text that you can brush past. It is a very grave warning. It means JUNS literally cannot fund its current strategy using its existing cash reserves. Without a constant influx of fresh, highly dilutive capital, the clinical trials just stop and the company hits a brick wall.
Let's break down their liquidity directly. At the end of June 2026, they had just $1.52 million in cash on hand, against that half-year cash burn of $3.73 million. So we're talking about what, maybe 2.5 months of runway? Now, they do have a lifeline. They have a standby equity purchase agreement, a SEPA, with Yorkville, showing $17.2 million available. And they did just manage to pull off a $2 million direct offering back in August. But you really have to understand how a SEPA works. It's a financial tool where the company basically prints brand new shares to sell to an institution at a discount. So tapping into that SEPA facility means guaranteed brutal shareholder dilution. Yes, they get the cash to survive for another day, but your ownership stake as an investor gets chopped into smaller and smaller pieces.
To try and manage this immense pressure, and honestly to just maintain the minimum bid price on the NASDAQ so they wouldn't get delisted, Jupiter executed a massive 1-for-75 reverse stock split on August 6, 2026. This was aggressive. It crushed the outstanding share count from nearly 58 million all the way down to a microscopic 770,000 shares. Now, it is absolutely vital to realize that a reverse split creates zero actual economic value, none. But what it does do is create a tiny, highly manipulative float. This is a classic, glaring warning sign of deep financing pressure, and it sets the perfect stage for extreme, completely irrational market volatility. And right on cue, that extreme volatility exploded just 2 weeks later. On August 21st, the stock suddenly surged to $8.24 intraday. But here is the truly wild part about that day. Over 45 million shares traded hands. 45 million. Remember, the float was only around 770,000 shares. That means the entire available supply of the company changed hands dozens and dozens of times in a single trading session. This perfectly illustrates that right now, the stock price is completely disconnected from the actual fundamentals of the business. It's not functioning as an investment, it's acting as a momentum trader's casino. So, given all this absolute chaos, how on earth do we build an analytical framework to value this thing? Well, we have to rely on probability. Analysts come up with these figures by looking at the historical success rates of phase 2 central nervous system trials across the entire biotech industry. And historically, these trials fail much more often than they succeed. In this case, the analyst assigns a 50% probability to the bear case, a 35% chance to the base case, and just a 15% chance to the bull case. Think about that. It is quite literally a coin flip chance that this ends terribly for investors. In the world of clinical biotech, the risk of failure isn't just a possibility, it's always the dominant statistical probability. This creates a setup of extreme asymmetry. If that 50% bear case hits, meaning JOTROL fails its phase 2 trial and the capital totally dries up, the estimated equity value crashes to just $2 million. For equity holders, that is a near total loss. The base case sits at a modest $12 million. But look at the bull case. If phase 2 actually provides strong data and ALA-002 advances successfully, the equity value could theoretically explode to $75 million or more. It's the classic biotech gamble. Success yields massive exponential multiples, but clinical failure wipes the slate entirely clean. Taking all of this deeply unbalanced risk into account, we arrive at the cold, hard verdict from the research. The official rating? A definitive avoid. The conviction level is extremely high at 8.5 out of 10, and the risk level is frankly flagged as extreme. The analyst highly discourages any systematic investing strategies here, like dollar-cost averaging. Seriously, you absolutely shouldn't be buying more shares as the price drops, trying to lower your average cost, because averaging down on a failing clinical biotech just accelerates and compounds your losses. The overall strategy is crystal clear. Avoid this stock completely. Unless you are a highly aggressive biotech specialist who is willing to make a tiny, purely speculative bet, just stay away. And even then, wait for that phase 2 data validation first. To summarize the core reality of Jupiter Neurosciences, you really only need to remember one phrase. JUNS is a clinical catalyst stock, not an earnings stock. If you're coming in here analyzing this company expecting steady growth, compounding revenues, or any sort of traditional intrinsic value, you are playing the wrong game entirely. This is a binary, event-driven asset. It is completely detached from standard fundamental investing, and it lives and dies strictly by its next clinical data readout. Which leaves us with a final provocative thought to wrap up this explainer. When you look at the massive dilution risks, the microscopic and easily manipulated float, the intense operating cash burn, and the completely binary clinical outcomes, at these extremes, are you truly investing or are you just gambling? It's a crucial, necessary question you have to ask yourself before ever stepping into the incredibly volatile arena of microcap biotech. Keep that in mind and keep learning.